Welcome to the Evalesco Healthy, Wealthy and Happy podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decisions in relation to your particular requirements or circumstances.
Welcome to the Evalesco Healthy, Wealthy and Happy podcast. My name is Jeff and I'll be your host for today. I'm very pleased to be joined by Paul Liu, our insurance specialist guru advisor from Evalesco. Thanks for coming along, Paul.
Thank you, Jeff.
As we always kick things off with, let us know, what have you been up to lately that keeps you healthy and happy?
In terms of keeping healthy and happy, so recently the team did a push-up challenge, which was a lot of fun, just to try to get back into some fitness routine for myself. I got the kids involved as well, which was great. So that was really good. If I can sneak away for a little bit, I'd love to go do a bit of snowboarding with the family as well. So that's my special hobby, that's my happy place. Excellent. I'd like to say. Yep.
Good stuff. And Paul kept a very detailed spreadsheet of his push-up feats over the month of the challenge as well, which was pretty impressive. So put the rest of us to shame. So well done on that. So as I said, you're the insurance specialist advisor here at Evalesco. One of your primary functions is to give people advice around life insurance. Mm-hmm. So today we're going to focus in on that as a specific component. So Starting off with, what is life insurance?
Life insurance is a broad term which includes 4 different types of cover. So life insurance being the first one, which is a benefit that's payable in the event of your death or if you are diagnosed with a terminal illness. And then we have total and permanent disability. We have trauma insurance as well. And then finally income protection insurance. Mm-hmm.
So today's conversation, we're going to focus in on the first one, which is that benefit payable in the event of death or terminal illness. Mm-hmm. When is it a good time for people to consider taking out life insurance?
Typically, we find for most of our clients, the triggers for a person to start thinking about life insurance is when they get married. Okay, so that's the first thing. Your life becomes about other people as well. So not just about looking after yourself. The next one is when you take out a mortgage. So now you've got for a lot of Australians, a pretty significant financial burden that needs to be taken care of as well. Mm-hmm. And then finally, once you start a family, because now it's certainly about a lot more than protecting yourself and your significant other, but you've got little people that you need to look after as well. Mm-hmm. Yeah.
And how do you know how much cover should you have?
It really varies depending on a person's circumstances and their preferences as well. But typically we start by asking our clients, okay, if you were to pass away unexpectedly, what are the sorts of things that need to be taken care of to ensure that your family are going to be left in a comfortable financial position? And that usually entails making sure that debts can be paid off. Mm-hmm. It usually also means making sure that you've got some money left over to provide an income stream of sorts if your spouse is non-working or if they don't earn quite as much as you do or enough to cover their living expenses. And then sometimes we have people wanting to provide an additional lump sum to cover school fees for children. It can be a gift for children to have a little bit of a kickstart in life. Should you be taken away unexpectedly and not able to provide those things to them yourself? So those are the things that we normally start with, and it depends on a person's circumstances and what they would like to have for themselves.
Yep. So a lot of the different variations and the reason it is so tailored and personalised is because people come to see us at different stages, don't they? So they might be closer to retirement, or they might have a newborn child. So they get onto it at that third trigger point that you mentioned earlier, and they've got a child who might be dependent for 25 years, then that's a lot longer to prepare for. Or they've just bought a home, they've got a higher mortgage, so they might need a higher level of insurance at that point in time.
Yeah, that's absolutely right. And part of our job as advisors is to make sure that we we talk to our clients and help them understand what their needs are at different stages in life. And we'll catch up from time to time to review their insurance. And if their circumstances mean that they need to increase their insurance, then we'll help them with that. But certainly if they're at a stage in life where the insurance is not as important anymore, then we'll help them, make the right decision in reducing cover if that's the appropriate thing to do as well.
What might be some of the reasons that the insurance becomes less important?
If your mortgage is reduced and you no longer need to provide that level of cover anymore, you might reduce your insurance in line with your debts. Certainly if your children have grown up and they're no longer financially dependent on you, then you would think about pulling back cover in that circumstance as well. And of course, if you have been working on your financial planning and building your investments in superannuation and everything goes according to plan and you get to the point where if a catastrophic event were to happen, you're still able to draw on your savings, your investments to cover those expenses, then we would say that you're probably in a position where you can self-insure and therefore don't need to be paying for that life insurance any longer, or certainly reduce it.
Yep. Makes a lot of sense. Sometimes, or maybe often, people have insurance in their super fund. Mm-hmm. Is it a good idea is that good? And is it a good idea to have life insurance owned in super?
Having your life insurance set up inside your super fund has a lot of benefits. Typically, some of the key benefits are, the super fund pays the premium on your behalf, so that helps reduce the impact to your cash flow. So a lot of people will use superannuation to pay for their insurance for that reason. When your superannuation pays for the insurance premium on your behalf, there are some tax advantages there as well. Typically, the super fund can claim a tax deduction of around 15% on whatever insurance premiums it pays on your behalf. Yeah.
Mm-hmm. And what's the downside of having insurance in super?
So if you have your insurance set up inside super and you leave it unchecked for too long, that insurance premium can increase over time. And, if you're not careful with it, it could leave you with a significantly diminished superannuation balance. So it is something that we like to check in with our clients on a regular basis to make sure that it is still the right level of cover and the cost isn't, causing a significant disadvantage to their superannuation balance as well.
And who can be a beneficiary, or who can get the benefit of your insurance in super or outside of super?
So if you're using your superannuation to hold your life insurance, typically you can nominate your beneficiaries, the people who are to receive that benefit in the event of your death, as a spouse or a dependent child, or someone with whom you're in a financially interdependent relationship with. If you've nominated someone who's in one of those three categories, they can typically receive that death benefit tax-free. Mm-hmm. However, if your children are no longer financially dependent on you and you've nominated them as a beneficiary, they may be over 18, out in the workforce, earning their own income, and they receive a death benefit from your superannuation fund, they may be liable to pay tax of up to 32% on that benefit. We sometimes see people nominating their parents as beneficiaries, which is a lovely thing to do, of course, but they may be unaware of that tax consequence should their parents be the direct recipient of that death benefit.
Yeah, that's a really important one to consider, that potential tax applies to your superannuation benefit, whether it's on the basis of a life insurance payout or just accumulated benefits, sometimes for certain components of your super. So it's an important one for people to think about.
Absolutely.
As they move closer to wanting to transfer some of their wealth, or when they are protecting. And that's where reviewing your insurance when your kids do leave home or those types of things is an important, trigger point on the other end as well, isn't it?
That's absolutely right.
Yep. Who can be a beneficiary if you have the policy outside of super?
If you hold your policy outside of superannuation, there are less restrictions around who you can nominate as the beneficiary. So in the case of a non-superannuation life insurance policy, you can nominate your parents, siblings, adult children as the beneficiary of that policy. And in most cases, they would be able to receive that benefit tax-free as well.
Yeah, and typically that's usually done through a will.
You can do it through a will, or you can nominate them as direct beneficiary as well. Yeah.
Okay. Fantastic. In wrapping up, any final tips or traps when it comes to life insurance?
Life insurance is my life. It's all I've ever done. So when it comes to life insurance, I do find myself, sort of chasing the detail and going down various rabbit holes in making sure that I understand everything and able to give the right advice to our clients as well. I would start by saying, have a look at your insurance. And simple questions would be to say, if I died yesterday and this was what was left to my family, is it going to be enough to make sure that they're not going to be left in financial distress should something happen to me unexpectedly? And if you're unsure of what that might be or what your options are, then certainly come and speak to an insurance advisor. When we're providing insurance advice, the fee structure is a little bit different. Certainly you can come and have a talk to one of us at Evalesco just to get an initial chat and some ideas around what can be done there.
Fantastic. That's great. I think Paul's done a great job in making that sound very simple, which was the intent. But there is a lot that can go wrong and a lot that can benefit people by getting that structure right and asking those questions and getting some advice. So please do feel free to take up Paul's offer of a conversation. If you do have any questions, reach out to your advisor, get in touch with Paul or myself. Thanks, Paul, for sharing your expertise and the great work you do for our clients. And everybody at home, thanks for watching and have a great day.
Thanks for tuning in to the Evalesco Healthy, Wealthy and Happy podcast. If you would like to learn more about anything you've heard in this episode, please give us a call on 02 9232 6800 or email admin@evalesco.com.au. Make sure to subscribe to our channel for more Evalesco podcast episodes and stay up to date by following us on Instagram and Facebook.